Welcome back. Today we are talking about expenses, assets, and how the IRS defines them. We will also go over tax reform changes to their treatment and reporting. For business owners often think if they pay money for anything that is related to their business, it is a business expense. While this is often true, sometimes it is not. For an expenditure that falls under a different IRS definition may cause different deductibility rules and limits to be applicable, therefore putting the business owner at risk of an audit due to an overstatement of their expenses. This may result in unnecessary penalties and interest, along with an increase in tax liability for the year in question, and nobody wants that. Prevent that from happening to your business by understanding the difference of these expenditures. The IRS defines deductible expenses as both ordinary and necessary. An ordinary business expense is one that is common and accepted for your trade or business. A necessary business expense is one that is helpful and appropriate for your trade or business. It is important to separate business expenses from cost of goods sold, capital expenses, and personal expenses. For cost of goods sold is deducted when the product related to the expenses is sold rather than when the cost is incurred, and personal expenses are not deductible at all. Furthermore, capital expenses must be capitalized rather than deducted, for these costs are part of your investment in your business and are considered assets, for they have a useful life of greater than 1 year. In general, there are 3 types of costs that can be capitalized: startup costs, assets, and improvements. Note, you can elect to deduct or amortize certain startup costs, and capital assets get depreciated over their useful life instead of deducting them in the year of purchase. However, certain capital expenses may qualify for preferential deductibility if they qualify for Section 179 or bonus depreciation. Here, the tax reform brought a few preferential changes to asset depreciation. The tax reform doubled Section 179 expensing limit to $1 million and increased the phase-out amount to $2.5 million. Bonus depreciation was also doubled to 100% and now includes used assets as qualified assets, effective for assets purchased and placed in service after September 27, 2017 through January 1, 2023. Thus, meeting assets versus expenses IRS definition affect business record keeping or reporting? That is the question. Yes, of course it does, or otherwise we would not be talking about it. Generally, business expenses and assets are reported completely differently on the tax return, but most importantly, the way they are reported may yield a different deduction for the current year tax return. Further, it is required to keep track of the assets the company has on its books and later report them to the IRS when those assets are sold or otherwise disposed of. There is none such requirement for expenses. Are there any exceptions? Yes, like always. For every general rule, generally there is an exception. Capital expenditures may qualify for the de minimis safe harbor election to be treated as expenses instead of capital assets up to a certain dollar amount per asset or invoice if qualifications are met. This means tax return reporting and record keeping becomes simpler for both the taxpayer and their tax accountant. I don't think I even have to say which one I use for my business and try to qualify most of my clients for. That is all I have for today. Until next time.